China's rapid recovery from the COVID-19 pandemic has increased investors' confidence in its financial markets. And that looks set to rise with the decision to list Chinese government bonds on the London FTSE Russell Index flagship World Government Bond Index from October next year. With 10-year government bonds yielding an attractive 3% on the current global zero-rate context, how will the listing affect China's economic development and what effect it will have on the market accessibility for overseas investors? What are the risks for financial regulators? And what does it mean for post-pandemic economic recovery? To talk about these issues, I'm joined by Professor John Gong from the University of International Business and Economics, Daniel Gross, Director of the Center for European Policy Studies, and Anthony Chen, former J.P. Morgan Chase Chief Economist. That's our topic. This is Dialogue. I'm Zhou Yue. So first of all, I want each and every one of you to have your say on what exactly does the listing mean for the world?
Well, I think the listing means that investment in the Chinese Treasury bills and bonds we're going to be part of the index funds, and there will be a lot of infusion of capital who are investment strategies being following these index funds, and that means that they have to buy, invest in Chinese bonds, government-issued bonds. And the direct result of this is going to be a huge infusion of capital. We discussed this. Some people estimate it's going to be in the range of $100 billion to $150 billion. And that has a huge implication on the currency exchange rate right now. So we'll see what's going to happen. But it's going to be some time. It's going to be effective from October next year. So it's going to be some time, though. We'll see what's going to happen.
Anthony, what is your take on the listing of the Chinese government's bond on FTSE?
My view is that the change is long overdue. Remember that China is now the second largest bond market in the world. And so I realize that many of these indices wanted to see different changes taking place, such as increased liquidity, much easier way to do foreign exchange transactions and to settle these trades. But the fact that the Chinese bond market is so large says to me that this is something that had to take place. It was just a matter of time, not whether it would take place.
And Daniel, what is your view in general?
It is indeed a step that has had to take place much earlier, but it is important because it is a signal that the internationalization of the Chinese renminbi and the Chinese financial system is moving slowly, but it's moving ahead. And over time, if the direction is maintained, then the renminbi could become very quickly a major international currency.
But Tony, you said this is long overdue. Last September, the FTSE Russell Index chose not to follow Bloomberg Barclays Global Aggregate Index or J.P. Morgan Government's Bond Index, Emerging Markets Global Index, to include the Chinese bond. Why didn't they last year? Why did they choose it to do it now?
It's very clear. They were not satisfied with the amount of liquidity, the foreign exchange controls that were in place. They were certainly waiting to see those things improve. I think that the Chinese government and financial markets certainly moved in that direction. And at this stage, they're a lot more satisfied. It was just a matter of time when this would take place. But now that the issues that they had problems with are going away, they're ready now to move in that direction. Now, keep in mind that this is still needs to be approved, and it doesn't go into effect until next year. Yep. But certainly now that we've started the wheels, that the wheels are in motion, I really have no doubt that we are going to get the full integration of Chinese government bonds into the world economy. Should have been done much sooner.
And Daniel, earlier you want to weigh in on why this is the appropriate timing?
It is, let's say, the last possible timing because, as was said beforehand, the Chinese bond market is so big that it's very difficult to keep investors away from this big market. And the decision itself is not so much important as all these small things which China has done to make it possible, namely to make the foreign exchange market more transparent, to provide for greater liquidity. All these ancillary changes are very important to integrate the Chinese financial system with that of the rest of the world.
And John, why there is sudden more transparency and liquidity in the Chinese international currency exchange?
Yeah, well, I think there are two reasons behind, I can think of, that are behind the FTSE Russell's decision. One is that, you know, the opening up China's market, financial market, is happening at a rapid pace, in my opinion. Many measures have been introduced so far, so I think it's an unstoppable trend that we're moving definitely into that direction, and I don't think any going back anytime soon. I don't think it's going to happen. The second thing is that the yield on the bond market here in China is actually very attractive. I mean, 3%, almost a risk-free return. You know, you compare with almost zero yields on other government bonds, if not negative sometimes in some other countries. So this is actually a very attractive investment opportunity. You know, these things go both ways. I think you know, works out here in China, and also works out for the international investors. Right now, it's a very small portion of the China's, you know, the speaker said it's the second largest bond market in the world. Small percentage is actually held by foreign investors, and there's a huge potential, in my opinion. There's a huge potential for international investors to participate in this boom.
Anthony, do you think it is more about the vote of confidence in China's liberalization of its financial market, or is it because, as John mentioned, differences of interest rates between China and the rest of the world?
Well, I think that the difference in interest rates is important, but it's not the overwhelming consideration, because interest rates go up and interest rates go down. But the importance of the Chinese economy is growing, and that's going to continue whether relative interest rates are high or low. I like the point that Chinese bonds or the bond market is a small percentage of the rest of the world. Something like 2.5% of the world bond holdings are held by foreigners. So that certainly is not justified in an environment where the Chinese economy is the second largest economy in the world, and certainly the second largest bond market. It makes no sense not to include them. My feeling is that we are seeing more confidence. Now in the financial markets, you're allowing foreign companies to have full ownership rather than a joint venture. So all these steps are certainly an indication that the Chinese financial markets are opening up, and it's just a matter of time. And we've already seen some progress with regard to equities, as many of these indices have allowed Chinese equities to go into their indices. It only made sense for the fixed income market to join the parade of this openness of these markets and the importance of these markets.
And Daniel, and some other people say it is because of China's economic recovery after COVID. Probably China is the only major economy in the world that has made that happen, and that is why investors are looking upbeat about the market here. Does that make sense?
Yes, that's certainly one of the factors why the rest of the world is looking with great interest at Chinese financial markets. But again, the key problem is not so much that they promise 3%, but how liquid is the market? How quickly can you sell if you need to be?
Yeah.
What are the costs of hedging? All of these things are also improving, but they are really decisive in the long run.
So let's come back to how liquid is the bond market for foreign investors. Basically, bond market is not a very liquidable equity, but why still investors, especially foreign investors, are more interested in that?
Oh, this is absolutely important, because typically, you know, you're not just in making an investment in holding a bond. I mean, this is a part of a strategy, probably part of other transactions going at the same time, and money needs to be moving in and out very rapidly. So, you know, I think for this to be a viable investment option, it has to be, you know, conforming to the normal practices in other internationalized bond markets.
Is it also okay to understand there is no better alternative at this time because there is nowhere to invest?
Well, I think I give this this assessment sort of a grain of salt. I think that the COVID-19 thing is a temporary shock. I mean, we have to face the fact that China did very well compared to other countries, right? But as the previous guest has said, I think this is something kind of a sort of a short run and also not really fundamental. I think the real fundamental is the market mechanism. It's attuned to transactions like this, attuned to China being part of internationalized markets, right? So I think that's probably more long-term, more strategic. We did very well on COVID-19 thing, but investors, they put their money in China not just because that we did pretty well this year. I think they're really looking for long-term opportunity. They're coming here for a business opportunity, not just to make some investments in bonds, I think.
Talking about the long-term picture, Anthony, China promised that we will speed up financial market opening, but in what areas are you especially looking at, and what are the things that you think can be improved on?
Well, I think that the improvements can certainly be with regard to more flexibility with the foreign exchange and sort of the total removal of foreign exchange controls, which I think eventually will happen. When we say that a lot of these things are happening because the Chinese economy is recovering much stronger, and that's true. The economy this year in China probably will be growing in 2020, and while in the United States and in Europe, those economies will contract on a year-over-year basis while China is positive. But you got to remember that many of these indices, whether it be the Bloomberg or the JP Morgan indices, they started looking at including China in 2018 and 2019. That's even before any talk about recovery from COVID or any talk about how strong the Chinese economy is relative to the U.S. or whether relative interest rates were higher in China. It is a reflection of these longer-term trends, which we should not lose sight of. The long-term trends for China and their openness are very positive, and these indices are certainly reflecting that and certainly taking all that into account. And that's why the long-term outlook for the Chinese financial markets being integrated into the global financial markets is important. Remember that this is a great opportunity for diversification, and it's a great opportunity to just have more access to more financial market vehicles or entities that the international or foreign investor has exposure to. Yeah. It's very important.
And John, it is important to ask the question, will China be the target for investors who are looking for diversification? Anthony said that the full convertibility of Chinese currency may be just around the corner, but there is still debate here in China when that will happen.
Well, I think from a long-term perspective, investors have been looking for diversity and taking China as one of the options of being diversified for a long, long time. It's just that we have a situation where it's constraining free flow of capital and make things difficult to make these kind of transactions. I think that's deterring the foreign investors of moving massive amount of capital into China. But now things are starting to change. I think there's signs that the indications that the current administration is ready to really move on to this path, that we're going to really serious about opening up the financial market, right? So I think this is a narrative that foreign investors appear to be buying to, and that the actions speak for themselves. That this decision is a very strong proof that the international investors do have confidence in the future direction of China's financial market reform. So from that perspective, I think it's a very positive development. It also helps with not just the bond market, not just the fixed income market. I think with the the RMB convertibility issue, and that's a huge issue. It's a great step, a gigantic step towards that direction.
Let's talk a little bit about the currency story then. Daniel, joined the FTSE World Government Bond Index would obviously further increase foreign investors' participation and Chinese currency's exposure to the outside world. Already, it will make the yuan the fourth largest currency on the index after the dollar, euro, and the Japanese yen. So what does this say about the status of the Chinese currency in the short term and long term?
Well, the status of the Chinese economy can only increase. The Chinese economy is much bigger than that of Japan, so really already today the Chinese currency should have a bigger place on the global markets. But the decisive question then is, as we discussed earlier, about currency convertibility. Yeah. Are the Chinese authorities ready for this? Because that then means that you can no longer control the exchange rate. And the exchange rate actually might become too strong if foreign investors have too much confidence in the Chinese economy. And that is a fundamental choice which, for the time being, doesn't seem to have been made.
And John, I want you to respond to that. We cannot control currency rate, interest rates, and monetary policy at the same time.
I beg to disagree a little bit about the controllability issue. I think with at least $1 trillion, $2 trillion of foreign exchange reserves sitting in the bank, the government can indeed interfere into the market. I mean, they can intervene as it sees appropriate. When, for example, the local currency is being attacked by speculators, the Chinese government, I mean, the major banks here, Bank of China, for example, I mean, they have the resources, they have the capital to intervene in the market to hold these kind of attacks at bay.
But there's always a trade-off.
There's a history
which part you can control, which part you want to be flowing free.
I think at the end of the day, there's going to be a judgment. I think when time comes, when events like this happens, when consequences going to be on the line, definitely there's something any central bank is willing to do. Some other governments didn't do it very successfully in Thailand, for example, in the past, in Indonesia, during the 2008-2009 1999 financial crisis, Asian financial crisis. So, these things happen. And given the size of the market, right, I am quite confident that, this is not something that's so easily susceptible to sort of these speculative attacks like this that has happened in the past in other countries.
Talking about the government bonds, of course, China is also a big holder of the U.S. Treasury bonds, but the Treasury bonds, they're being talked about the future potential of the U.S. Treasury bond. Tony, do you think investors might hedge their bets towards the Chinese assets? What is your view?
Well, right now, the Chinese bond yields are much higher than they are in the United States, so obviously a little bit more attractive. But I think that in the real world, a foreign investor wants to have exposure to all these markets. And even though bond yields are as low as they are in the United States, believe it or not, on a year-to-date basis, government bonds in the United States are outperforming the S&P 500 on a year-to-date basis. Yes, we've gotten a huge recovery from the bottoms of the U.S. equity market that it hit in March 23rd, but on a year-to-date basis, these bonds have done very well. So
that's basically confidence in the U.S. economy. Is that it? If COVID is still keeping U.S. from coming back, will that change?
No, I don't think so much. It is some confidence, but I think the reason why bond yields are so low is because we have so much quantitative easing in the United States, something that China has not done as much. China has not been as aggressive. If you look at the benchmark yield, it's above 3% in China. In the United States, we know that the Fed funds rate is closer to 0%, and that's a function of what the central bank is doing. So I think that's the reason why bond yields are so low, and inflation is still under control in the United States, coming in actually below the target. So these are all reasons why the interest rate in China is much more attractive than it is in the United States, which is something that foreign investors will pay attention to.
And Daniel, do you think this might change the landscape of international financial transactions? Any direction?
The landscape will not change from today to tomorrow, not even next year. but the direction is clear. China will open, and the renminbi will become more important internationally. Now, it all depends at what speed. Does it happen over the next 3 or 4 years, over the next 20 years? And that's where many investors are still hesitating, because they don't know how quickly China will go ahead. And that, of course, puts them into a position where they say, better be cautious. We never know whether this will always go on, whether there might be a pushback because of some temporary difficulties. And therefore, it is very clear that the Chinese authorities say not only that they're going ahead in this direction, but also at what speed.
So, John, you want to answer the pace question?
Yeah, well, I want to address a little bit the landscape question you asked about.
All right.
I think the financial market is one area where the so-called decoupling between China and the United States is absolutely not true. It's if on the contrary, it's actually further integrated.
It proves the opposite.
It's opposed the opposite direction, exactly. I mean, for the last couple of months, you see a lot more investment, capital investment from the United States actually coming to China, including both.
Actually, over the past years.
Yeah, that's right.
Including 40% increase in Chinese bonds.
Including both foreign direct investment as well as financial short-term investment like this. So, so I think, amid this hoopla about decoupling, driving corporate Americas operating here in China back to the United States, what the fundamental economic forces are pushing is something up the opposite direction, exactly the opposite direction. The two largest economies in the world are really fundamentally intertwined. And if you look at the financial markets, exactly that's what's happening.
Yeah, if you're a financier, you're looking at more money going in and out from different countries between China and the other markets. That's a good sign.
Right. Yeah, absolutely. Right.
What about the pace question that Daniel just asked?
The pace question.
Is it 5 year, 10 year, or 20 years?
That's a wild guess. That's a wild guess. I'm quite confident that the things can happen very fast in the financial market area. I mean, look at the past half year. One measure introduced after another, and the market in general has been resonating quite well. So at this pace, I think you're probably going to see a very different financial market in 2 to 3 years' time.
I think that has also a lot to do with the risks question. What are the risks if China's financial market opening up too quickly for its own financial stability or its economic viability?
Well, I mean, when people talk about risk, a lot of people are thinking about the political risk. This financial market is exposed to the foreign investors, kind of a political risk. I'm a little bit skeptical about this because, the foreign investments in the financial sector coming into China mostly, in my opinion, in the wealth management area, in bond market, in this case, in equity markets, are mostly in those kind of markets. But the more fundamental financial, commercial banking area is firmly in the hands of the domestic banks. As a matter of fact, in the hands of the SOE banks, these big, Bank of China, Bank of China's Construction Bank, these big behemoth banks. So I don't think that foundation is going to be shaken anyway by foreign infusion of capital. So I'm a little bit skeptical about this theory that too much risk if we open up too fast, too much. Look at the other economies, right? And the United States is very open in the financial market. Singapore is very open in the financial market. I mean, they haven't seen the kind of risk people have been talking about.
Let's come back to the bond market story. And Anthony, some investors that estimate at least $100 billion will flow into China after the FTSE's inclusion. What kind of a market size are you looking at?
I think that's a reasonable number. I'm looking for about 125 billion. I mean, we are seeing that right now. Foreign investors already own almost $500 billion of Chinese bonds. So that if you continue to see this kind of a flow, and by the way, in the recent years, you've seen that foreign investors have been growing almost at a 40% clip. So you can clearly see this excitement. And now with this FTSE index, which is more passive in nature than either the JP Morgan or the Bloomberg, that tells me that there's going to be a much faster adoption. And with regard to the foreign exchange, I'm not so worried about allowing or opening up foreign exchange. Yes, there could be some speculative attacks, but again, you can have some intervention. Many of the developed economies have the option of intervention, but the more you open it, the greater the importance of the renminbi as an international reserve currency will grow. And that is something that I think China should welcome because it's the second largest economy in the world. It makes no sense for that currency not to have greater importance in the international landscape. And that's what will happen as you open up the currency and you relax those capital controls.
And John, what will that do to the Chinese domestic market and investors, and also the interest rates?
Well, I think it will make the interest rates more aligned with international markets because we have this arbitrage thing that capital can move in and out very quickly. So it's going to be a much more liquid market. And this actually, in general, is a good thing for the economy. I mean, a more lubricant financial market does wonderful things for the industrial part of the economy. I'm all for it, actually. I think it's a great thing that we can, if we can accelerate this pace of making the RMB a more convertible currency. Right now, the total share of the transactions denominated in RMB is very small, and we hope that that ratio can increase dramatically in the future.
And Daniel, would you want to make your predictions about its impact on Chinese government's infrastructure projects and its economic recovery plans?
I think that with
in the short run,
oh, I'm sorry.
Daniel?
In the short run, these moves will have very little impact on the overall economy of China and the recovery, which is very strong, because that does not depend on foreign capital flowing in. China has enough domestic savings to finance all of its investment and to finance its own government. Therefore, I think that in the short run, the impact on China will be limited. The impact on financial markets in the rest of the world might actually be more important. But it might also be limited by the fact that was mentioned earlier, that actually the financial system of China is dominated by these very large state-owned banks. And that by itself limits the size and the liquidity of the bond and other markets. We have seen that also in the euro area. When the banks are so important, it becomes more difficult to have a liquid bond market, especially for private enterprises. So that would be a second factor which has to be taken into account. Will the Chinese financial system remain dominated by the banks, or will there be more a way towards non-bank financing, in which then, of course, foreign investors would be very happy to participate?
Yeah. You agree that will be a total new financing picture in China? Anthony?
Yeah, I do. I mean, the commercial banks in China today own a little bit more than 60% of the bonds, so they are the major players. As you start to bring in the foreign investors, you'll see a diversification of that ownership. And I think that's very positive for the Chinese financial markets.
Yeah, probably that's why the regulators want to do that in the first place. Well, we're running out of time. Thank you very much, Daniel and Anthony and John. And you've been watching Dialogue here on CGTN. I'm Joe in Beijing. Thanks so much for watching. Goodbye.